We now apply the principles and tools we have developed to corporate financial decisions. As we have discussed earlier, corporate decisions lead to changes on both the asset and liability side of the balance sheet. We consider them in turn. Changes to the asset side come primarily from the firm's real investments. These investment decisions are also referred to as capital budgeting, that is, what projects to invest in. The nature of these projects is very general, ranging from expanding existing business to mergers and acquisitions to a marketing plan or an IT upgrade to new business lines, you name it. These projects will all add new assets to the firm, which lead to future cash flows or earnings. Changes to the liability side are related to several financial decisions. The first is the financing decision, namely how the firm finances its business or assets. A firm does so by selling financial assets or claims, such as taking a bank loan, issuing debt, stock, and other corporate securities. The second financial decision is payout, that is, what to pay to the firm's shareholders. This includes when and how much the firm pays its dividends or buy back its shares. Since payout is primarily about servicing the stockholders, it can also be viewed as part of financing. The third financial decision is risk management. Naturally, the firm's business or assets are exposed to a range of risks. Some are systematic, and some are non-systematic or idiosyncratic. What should the firm do with these risks? With a rich array of financial contracts traded in the market, the firm can easily use them to adjust its risk exposures. Two important questions arise. First, what risk should the firm keep, and what risk should the firm unload in the market? Second, how can the firm achieve a risk management goal after setting one? Using the balance sheet of the firm, we can easily capture these decisions. The asset side reflects the firm's real investments, in particular the fixed assets. The liability side reflects the firm's financing, payout, and risk management situations. As an illustration, let us consider a concrete example. What is shown on the slide is the balance sheet of Amazon in 1996 and 1997. The numbers are in $1,000. In 1996, Amazon's total assets are worth roughly $8.2 million. Most of them are in cash and securities, about $6.2 million. Fixed assets are about $1.1 million. The remaining are inventories and prepaid expenses. On the liability side, Amazon has $2.8 million in accounts payable and $2.0 million in accrued expenses. It had no debt. The equity is $3.4 million. The total liability amounts to $8.2 million, the same as the total asset. In 1997, Amazon's balance sheet has changed a lot, increased by about 18 times. The total assets are now worth $149 million, with most of it still in liquid assets such as cash and securities, for about $125 million in total. That's an increase of more than 19 times from the year before. Fixed assets have also increased by about 10 times to $11.6 million. On the liability side, Amazon has taken on new debt to finance its growth. The debt level has become $78.2 million, while it was zero the year before. The equity value has also increased to $28.4 million. Accounts payable, the other big item, at $32.6 million. Being an online retailer, at least then, this is not surprising. So is the large cash reserve. The balance sheet in 1996 and 1997 clearly reflect what Amazon did in 1997. It issued new equity through its IPO in 1997 and also issued new debt. The funds raised were used to expand its business, including substantial investments in fixed assets. What's shown on this slide is Amazon's balance sheet at the end of 2018. By this point, Amazon is already one of the largest companies in the world. The fixed assets have grown to over $61.7 billion, while the total assets have grown to $162 billion. Debt has also grown to over $23.4 billion and equity to over $43.5 billion. These are all in book value. The market value of Amazon's equity was $773.5 billion at the end of 2018. This slide shows Amazon's acquisition of Whole Foods, a food retail chain, in 2017 at the price of $13.7 billion. This reflects Amazon's expansion into one of the more traditional retail markets. Amazon financed this purchase by issuing $16 billion of bonds. Clearly, after these transactions, Amazon's asset side will now have Whole Foods as its new assets, and its liability side will see an increase of debt by $16 billion. The difference of $2.3 billion will also end up on the asset side, of course. In this course, we will consider corporate finance decisions in three parts. The first part is capital budgeting, which consists of two topics. First, basic capital budgeting, and two, real options, that is, strategic optionality embedded in real investments. The second part is financing or capital structure. This part consists of three main topics. First, optimal capital structure. Second, interaction between investments and financing. And third, payout policy. The third part is on a firm's risk management strategy and its implementation. We will consider basic capital budgeting first and return to the rest of the corporate finance topics in part 2 of this course, after we have developed all the tools needed on asset valuation, risk analysis, and risk management. We now consider a firm's real investment or capital budgeting decision. The decision really boils down to the valuation of the investment or the project under consideration. For simplicity, let's assume that the project requires an initial investment of $1 million, and it then yields an expected return, say X, over the coming year. How can we tell if this is a good project? First, we know that the manager can always return the cash to the firm's shareholders in the form of a dividend, for example. Second, shareholders can easily invest the money in the financial market. Suppose that investment opportunities in the market with similar timing and risk characteristics as the project offer an expected rate of return R. This then gives us a benchmark to judge the project. We should take the project only if its expected rate of return, X, exceeds R. Otherwise, the shareholders can just take the money and invest in the market, bearing the same risk they can earn R with no cost and effort. We have first introduced this idea in the introduction. We now provide a more formal treatment. Given an asset or project under evaluation, we define its opportunity cost of capital as the expected rate of return offered by equivalent investments in the financial market, where equivalent refers to their timing and risk characteristics. The reason for this notion is straightforward. If we are going to invest in the project, we will forego the return offered by the similar assets traded in the market, which is easily available. It is important to know that the cost of capital is always associated with an asset or project under consideration, reflecting the market's expectation of the return on the asset. It is not related to factors like the firm's cost of financing by borrowing or other means. Given the opportunity cost of capital, sometimes labeled COC, of a project, the investment decision becomes straightforward. If the project yields a return higher than its cost of capital, we should take it. Otherwise, we should reject it. In this case, shareholders will be better off not taking it. If they are interested in investing assets with similar timing and risk characteristics, they can easily do so in the market and earn a higher return. We now formalize this idea a little bit more. Suppose that the project has the following cash flow. It requires an initial investment of I today. It yields a future cash flow CF1 in 1 year. The opportunity cost of capital for the project is R. What is the value created or destroyed by taking on this project? This is given by the net present value, or NPV, of the project, which is given by the following formula. The NPV should equal to the initial investment, which is minus I, plus the expected cash flow, CF1, discounted at the cost of capital, R. The decision then becomes straightforward. Take the project only if its NPV is positive. The firm's current market value should then increase by the project's NPV when it's taken or known to be taken. For now, we will assume that a project's cost of capital is given to us. But from the risk and pricing analysis we have just developed, we can find a project's cost of capital or expected rate of return easily. All we need to do is to find the risk loadings of the project's return or cash flow. Then by the arbitrage pricing theory, or APT, we can determine the project's required rate of return by the market. We will return to this part later. In our discussion so far, we have implicitly assumed that a manager's main objective in making various decisions is to create more value for the firm's stakeholders or shareholders. In particular, in making corporate financial decisions, the manager's goal is to maximize the current market value of the firm. This seems quite intuitive, but given that this is the starting point of our analysis of corporate finance, we would like to give it more careful consideration before moving ahead with it. For simplicity, in this part of our analysis, we assume that the firm is wholly owned by its shareholders. Thus, they are the sole stakeholders of the firm. Such a simplification avoids the potential conflicts of interest when the firm has different stakeholders, such as bondholders and stockholders. We will return to these situations later when we examine a firm's financial decisions where different stakeholders enter the picture. Under the notion that the manager should act in the best interests of the firm's shareholders, she faces many factors when making a real investment decision. Let's consider a few of these factors. First, Each investment has its horizon, namely a time span for its cash flow, say 1 year, 5 years, or longer. In general, shareholders do care about the timing of a cash flow. Should the manager, for example, favor projects with shorter horizons, other things equal? Next, investments are in general risky, and shareholders are on average risk averse. How should a manager deal with risk? Other things equal, say with the same expected payoff, should the manager always choose projects with lower risks? How about performance measures like earnings? Should the manager always favor projects yielding higher earnings? How should a manager balance between near-term earnings with long-term payoffs? Firms often give up short-term benefits to gain long-term returns, such as market share or new markets. Sometimes they do so despite the negative reactions from the market, arguing that they are pursuing long-term value. Does this make sense? The list can go on. But what we hope to show is that with the support of a well-functioning financial market, the only reasonable objective for the firm's manager is to maximize the current market value of the firm. Here are the reasons. First, current market value is an unbiased financial objective. It is determined and supported by the financial market and is realizable. You can realize the value of the project by simply selling the shares in the market. Second, current market value incorporates the market value of all future cash flows, properly adjusted for timing and risk. Factors like timing and risk are taken care of by the market valuation through the right discount rates or cost of capital. Long-term benefits, if they are recognized by the market, are also fully included in the expectation of future cash flows. Third, current market value is independent of shareholders' differences. We're going to elaborate a little bit more on this point. Again, we start with the notion that a firm's manager should act to help achieving its shareholders' financial objectives. Broadly speaking, shareholders' financial objectives are two-folded, as we have discussed at the beginning of the course. First, to increase wealth, that is, to increase the amount of economic resources at the household's disposal. This is listed on the slide as Objective A. Second, to deploy the wealth to best meet the household's economic needs, which is to achieve the optimal time pattern and risk profile for its consumption. These are listed as Objective B and C, respectively, on the slide. It is important to realize that with a well-functioning financial market, households can achieve Objective B and C through their own transactions in the market. For example, with $1 in wealth, a household can use it for consumption today or deposit it in the bank account for consumption at any future date. $1 put in a bank account gives a safe payoff in the future, but if the household wants more payoff when the economy does well, that is to keep up with the rest of the economy, like a professor to keep up with his students' future successes, the $1 should then be put in the stock market. The household does not need the manager of a firm it invests in to do any of these. In fact, it's also impossible for the firm's manager to worry about these decisions, as different shareholders may have very different financial needs along these dimensions. However, there is one dimension they are in common. It is Objective A, to have more wealth. This is where the firm's manager can help by increasing the firm's current market value, which goes into shareholders' wealth. This is why shareholders invest in the firm in the first place. To further illustrate these points, let's consider an example. Suppose that MassBiz is a company which is listed on NASDAQ. It is considering two business plans, A and B. They are mutually exclusive. That is, we can only choose one. We have the following information on these two plans. Both plans have positive NPV. Plan A has an NPV of $50 million. That is, if it's taken, the current market value of the company will increase by $50 million. Plan B has an NPV of $80 million. Plan A pays off in 3 years, and Plan B pays off in 10 years. In other words, they have quite a different horizons. Plan A expands the firm's current business with relatively low risk. Plan B is to enter a new line of business, which involves much higher risk. Which one should the firm take? The CEO is recommending Plan B to the board as it has a higher NPV, $80 million over $50 million. Since MassBiz grew out of a family business, its board consists of 3 controlling shareholders from the founding family, grandma, dad, and son. Here are their reactions after hearing from the CEO. Grandma dislikes B. I'm already 85 and probably won't be around to see any of its payoffs. Dad is also averse to B. It's too risky. I plan to enjoy a quiet retirement and have little appetite for risk. Son has serious reservations on B. The market is overhyped on the kind of business B is getting into. As the CEO, how should you respond? Clearly, shareholders' views are dictated by their own financial objectives and perspectives, which are perfectly reasonable but also quite divergent. Fortunately, as far as the firm's decision is concerned, it need not to be influenced by shareholder preferences. In particular, by taking Plan B, every shareholder's wealth will increase more by her or his share of the $30 million difference immediately. This makes all of them better off. Grandma should not worry about how long it takes for Plan B to pay off. Some investors in the market will live to see these payoffs. That is why they are willing to pay $80 million today for it. If Grandma needs money for current use, she can simply sell some of her shares at a high price now to raise cash. There's no need for Dad to worry about the risk of Plan B. He does not have to bear the risk of Plan B. If he prefers, he could sell his shares at a high price now for cash and then use the cash to buy safer assets like government bonds or low-risk stocks, only more of them. Son does not have to agree with the current market prices. The key is that some investors in the market are willing to pay the price, $80 million for Plan B. If Son is not sure about this valuation, again, he can liquidate his shares after taking on Plan B at high prices and then get out of the business. What should be clear is that despite the difference in shareholders' preferences and views, Plan B will make all of them better off than Plan A today. Their current wealth all increase more at the current market price. This has nothing to do with what they want to do with this new wealth. In particular, there's no need for any of them to hold their wealth in the form of the firm's stock in order to wait to see its future earnings, or bear the risk of the stock, or risk a future correction in the stock price. These are all decisions on how to invest their current wealth. They can make whatever choices according to their own preferences or views through their own transactions in the market. These choices are unrelated to the decision to increase the current market value of the firm. Therefore, Plan B is the right choice for the firm and also for all its shareholders. There are a few caveats worth pointing out here. First, our arguments above rely only on two assumptions about the financial market. First, it is well-functioning, meaning accessible to everyone with no frictions for various transactions. And second, rich, meaning it's efficient for resource allocation in time and risk. It does not necessarily require that market prices are correct, for whatever that means. In particular, you don't need to agree with the market prices. Second, it is assumed that the shareholders mainly care about the financial wealth generated from the firm. Given that the firm, in this case, was a family business to start with, and it's still controlled by the founding family, there might be other considerations for the shareholders, such as family name, etc. But these considerations can be addressed, if needed, within our framework. For example, if the family members want to hold on to the old business, they can take on Plan B to realize its market value and then sell it through a spin-off, for example. Third, it's assumed that there is no asymmetric information, especially between corporate insiders and the market, nor fake information by the firm. That is, the market valuation on Plan A and B reflects all the information available in the market. This is consistent with the efficient market hypotheses we just discussed in the previous lecture. In this case, trading by corporate insiders won't affect the firm's market prices. Let's consider one more example. Can Associates is a mining company which owns a gold mine, King Solomon's. It is considering whether to reopen the mine. We have the following data on the mine. The mine has a total deposit of 0.11 million ounces of gold. Extracting the gold takes 1 year. It requires initial investment of $86 million. Gold is currently traded at $800 per ounce. And the cost of capital for gold mine is 10%. Here, the cost of capital is given to us. But can you think of a way to find this number yourself using the valuation methods we develop in lectures on risk and factor models and arbitrage pricing theory? In addition, the current shareholders are evenly split into two groups: optimists who are bullish on gold prices and pessimists who are bearish. In particular, optimists expect the gold price to increase 20% next year. Pessimists expect the gold price to increase only 5%. Given the difference in their views, the two groups of shareholders may not agree on what the firm should do. For optimists, $1 million, the NPV for reopening the mine is minus 86, the production cost, plus the present value of future gold sales, which equals 0.11 million ounces of gold times the gold price now, which is 800, then times 1 plus the growth rate of 20% as they expected. Finishing the calculation, we have an NPV of $10 million plus. By this number, 10 should reopen the mine. For pessimists, the NPV is computed similarly, except the growth rate for gold price is expected to be 5%. So the NPV will be minus 86 again, the production cost, plus the expected future sales from gold, discounted at the 10% of cost of capital. If you finish the calculation, we get minus $2 million, which clearly goes against reopening the mine. What should the firm or the CFO do? Some might suggest taking an average over the two numbers. Why would any of the shareholders agree to this? Each side believes they are right. How about get the optimists to buy out the pessimists? Interesting idea, but at what price? Maybe you have more creative ideas to resolve this disagreement. Instead of going down further on these paths, let's take a step back and think it over. The key issue here is how to value 1 ounce of gold next year. Different shareholders have different views. Don't blame them. If the same question was put to us, most likely we won't agree. But wait a minute. All we need to know is not about the price of gold next year, but the present value of 1 ounce of gold in 1 year, but today. A little of poking around about the gold market, a very active market, we learned the following. Gold, at least those traded in the market, such as gold bullions and coins, is mostly held as a long-term investment with no interim payoffs. It is often viewed as a storage of value or hedge against inflation. If so, for these gold investors, 1 ounce of gold of next year is the same as 1 ounce of gold today. If they buy 1 ounce of gold today, most likely they will hold it until next year anyway, or even longer. In the interim, there's no payoff from the gold. This is different from holding a bond or stock, which may pay coupons or dividends during the year. Holding gold incurs little cost either. Physical gold is mostly stored at gold depositories with very low cost. It is the claims on them that change hands when investors buy and sell them. We will return to this market later in part 2 when we study derivative securities on commodities. From the above observation, we then conclude that 1 ounce of gold in 1 year is worth the same amount as 1 ounce of gold today. Given that 1 ounce of gold is trading at $800 now, the present value of 1 ounce of gold in 1 year is also $800 today. Immediately, we can conclude that the NPV of reopening the mine is simply minus 86, again the production cost, plus 0.11 million ounces of gold times the present value of 1 ounce of gold in 1 year, and that's $800. Finishing the calculation, we get plus $2 million, which is positive. This value is the value we can achieve today in the market. The current price for selling 1 ounce of gold delivered next year is $800. Therefore, by reopening the mine, the value of 10 associates will increase immediately by $2 million, which will make all shareholders richer. As for the shareholders themselves, with their own views on future gold prices, they can use the market to speculate on their forecasts. For example, for the pessimistic shareholders, they can sell the shares at a high price now. If that is not enough, they can even short gold in the market. Now let's wrap up our discussions on the objectives of a firm's financial manager. We have 3 important results. First, the manager should always maximize the firm's current market value, which is independent of shareholders' individual characteristics. Second, shareholders' financial differences can be settled in the financial market on their own. They can utilize the wealth created by the firm to meet their own consumption, saving, and investment needs separately, independent from the firm's decisions. Third, with the rich and well-functioning financial market, sometimes also called a perfect market, there can be a potential separation between ownership and management. As long as the management adheres to value maximization as the objective, they don't need to be attached to the shareholders or their preferences and views. The actual financial market is not 100% perfect, of course, although for mature markets, it could be quite close in many dimensions. Imperfections can lead to many additional issues. We only list a few important ones here. The first point is that a firm may have different stakeholders, such as bondholders, in addition to stockholders. Their interests then will not always be aligned. In particular, bondholders are mostly concerned about getting their principal back and interest paid. They care more about the downside of the firm than the upside. Shareholders, on the other hand, care more about the upside than the downside. These differences can influence a firm's financial decisions under certain circumstances. Second, with separation of management from ownership, the management may not always act in the best interest of the firm's owners. Instead, they may put their own interest first. In this situation, management is also referred to as the agent of the principal, which is the owner. The conflict of their interests is also called the agency problem. Our three conclusions above depend critically on a well-functioning financial market. In the presence of certain market imperfections, such as transaction costs, asymmetric information, and taxes, some of these results will need to be modified. For now, we will focus on corporate finance decisions with a perfect financial market. We will return to the influence of market imperfections in part 2 of this course.
To carry on business, a corporation needs real assets. For example, in order to produce cars, Tesla Motors needs a factory to assemble them. In corporate finance, a decision to build a factory is what we refer to as an investment decision. Investment decisions are the most important decisions made by the management of any firm. A firm's management must weigh the costs and benefits of all investments and project and decide which of them qualify as good uses of the money stockholders have invested in the firm. These investment decisions fundamentally shape what the firm does and whether it will add value for its owners. In this course, we will develop the tools necessary to make good investment decisions. Investment decisions are often referred to as capital budgeting decisions. Once management has decided which investments to make, they also decide how to pay for them. Large investments may require the corporation to raise additional money. Management must decide whether to raise more money from new and existing owners by selling more shares of stock or to borrow the money. In this course, we will discuss the characteristics of each source of funds and how to decide which one to use in the context of the corporation's overall mix of debt and equity. We call such decisions financing decisions. Let's consider an example. In summer 2018, Tesla Motors started developing and building a factory in Shanghai called Tesla Giga Shanghai. The facility is currently producing final assemblies of the Tesla Model 3 and will produce Tesla Model Y, with delivery slated to begin in January 2021. This is an example of investment decision. Now, in May 2019, Tesla issued and sold around 2,750,000 shares. In addition, around the same time, Tesla issued convertible notes, which is a type of instrument that has characteristics of both equity and debt, with a total value of around $1.35 billion. Both the issuance of shares and the issuance of convertible notes are examples of financing decisions by Tesla. In addition to investment and financing decisions, management must ensure that the firm has enough cash on hand to meet its day-to-day obligations. This job, commonly known as working capital management, may seem straightforward, but in a young and growing company, it can mean the difference between success and failure. Even companies with great products require significant amounts of money to develop and bring those products to market. For example, developing Airbus 380 cost billions of euros and took 7 years. A company typically burns through a significant amount of cash developing a new product before its sales generate income. It is the job of Chief Financial Officer or the CFO to make sure that access to cash does not hinder the firm's success. When a firm generates sufficient cash flow, it must decide how to use that cash. If the firm has new investment opportunities, it can reinvest the cash and increase the value of the firm. Many young, rapidly growing firms reinvest 100% of their cash flows in this way. But mature, profitable firms often find that they generate more cash than they need to fund all of their attractive investment opportunities. An example of such firms would be Apple and Microsoft right now. When the firm has excess cash, it can hold those funds as part of its cash reserves or pay the cash out to shareholders. If the firm decides to follow the latter approach, it has two choices. First, it can pay a dividend, or second, it can repurchase shares from the current owners. These decisions represent the firm's payout policy. In this course, we will discuss what determines a firm's payout policy. Another important corporate financial decision is risk management. All firms are subject to risk from a variety of sources. Changes in consumer tastes and demand for their products, fluctuations in the cost of raw materials, employee turnover, the entry of new competitors, and countless other uncertainties. Entrepreneurs and corporate managers willingly take on these risks in the pursuit of high returns and accept them as part of the cost of doing business. But as with any other cost, firms must manage risk to minimize the effect on the value of the firm. The primary method of risk management is prevention. For example, firms can avoid or at least reduce any potential risks by making prudent investment decisions and by conducting appropriate due diligence when entering into new relationships. But some risks are too costly to prevent and are inevitable consequences of running a business. The firm shares these business risks with its investors who buy securities issued by the firm. For example, some of the risk is passed on to debt holders who bear the risk that the firm will default. But most of the risk is typically passed to equity holders who are exposed to the volatility of the stock's return. Both types of investors can reduce their risk by holding the firm's securities in a well-diversified portfolio. In this course, we will consider the strategies that firms use to manage and reduce the risk borne by their investors. We will learn how firms can use financial markets to offload the risk associated with changes in commodity prices and interest rate movements. Suppose a firm wants to invest in a project. For example, recently Apple started its TV Plus service, which competes with Netflix, HBO, and other media services providers and production companies. To evaluate this decision, Apple needs to project future cash flows TV Plus will generate and discount them to present. Now, what discount rate should be used to evaluate this investment decision? The answer to this question is that Apple should use expected return offered in the market on an investment of comparable risk. To understand why, suppose Apple seeks to raise capital from outside investors to finance its investment in TV Plus. In order to attract funds, the firm must offer an expected return comparable to what investors could earn elsewhere with the same risk and horizon. But what if Apple can fund this project internally? As of March 2020, Apple has more than $40 billion in cash on its balance sheet. Clearly enough to fund any project. What discount rate should Apple use in order to determine whether they should invest in TV Plus if they can fund this project internally? The answer is the same rate as they would use if they finance the project with outside investors' money. This is because any funds invested in a new project could be returned to shareholders to invest elsewhere. The new project should be taken only if it offers a better return than shareholders' other investment opportunities. We call this discount rate the opportunity cost of capital, or simply the cost of capital for the project. The opportunity cost of capital is the best available expected return offered in the market on an investment of comparable risk and term to the cash flows being discounted. The opportunity cost of capital provides the benchmark against which the cash flows of the new investment should be evaluated. For a risk-free project, it will typically correspond to the interest rate on US Treasury securities with similar term. The cost of capital for risky projects will often exceed this amount, depending on the nature and magnitude of the risk. We will develop tools for estimating the cost of capital for risky projects later in the course. An important implication of this insight is that the cost of capital for a specific project may differ from the cost of capital for the entire firm. In our example, can we use Apple's cost of capital for the entire firm as the cost of capital for the TV Plus project? The answer is no. Apple's primary source of revenue is iPhone, which is a different product from the media production and distribution business. In order to evaluate TV Plus service, we need to use cost of capital of firms engaged in media business, such as Netflix. In theory, the goal of a firm should be determined by the firm's owners. A sole proprietorship has a single owner who runs the firm, so the goals of a sole proprietorship are the same as the owner's goals. But in organizational forms with multiple owners, the appropriate goal of the firm is not as clear. Many corporations have thousands of owners. Each owner is likely to have different interests and priorities. Whose interests and priorities determine the goals of the firm? You might be surprised to learn that the interests of shareholders are aligned for many, if not most, important decisions. That is because, regardless of their own personal financial position and stage in life, all the shareholders will agree that they are better off if management makes decisions that increase the value of their shares. For example, between January 2013 and June 2018, the stock price of Netflix has increased almost 30 times. Clearly, regardless of their preferences and other differences, all investors who held shares of Netflix stock over this period have benefited from the investment decisions that managers of Netflix have made. But even when all the owners of a corporation agree on the goals of the corporation, these goals must be implemented. In a simple organizational form, like a sole proprietorship, the owner who runs the firm can ensure that the firm's goals match his or her own. But a corporation is run by a management team separate from its owners, giving rise to conflicts of interest. How can the owner of a corporation ensure that the management team will implement their goals? Because of the separation of ownership and control in a corporation, managers have little incentive to work in the interest of the shareholders when this means working against their own self-interest. This is called an agency problem. When managers, despite being hired as agents of shareholders, put their own self-interest ahead of the interest of shareholders. This agency problem is commonly addressed in practice by minimizing the number of decisions managers must make for which their own self-interest substantially differs from the interest of the shareholders. For example, managers' compensation contracts are designed to ensure that most decisions in the shareholders' interests are also in the manager's interests. Shareholders often tie the compensation of top managers to the corporation's profits and to its stock price. There is, however, a limitation to this strategy. By tying compensation too closely to performance, the shareholders might be asking managers to take on more risk than they are comfortable taking. As a result, managers may make decisions that are too conservative. On the other hand, if compensation contracts reduce managers' risk by rewarding good performance, but limiting the penalty associated with poor performance, managers may have an incentive to take excessive risk. Another way shareholders can encourage managers to work in the interest of shareholders is to discipline them if they don't. If shareholders are unhappy with the CEO's performance, they could, in principle, pressure the board to oust the CEO. In 2019, for example, CEOs of Warner Brothers, Under Armour, Nike, and Boeing were all reportedly forced to resign by their boards. Despite these high-profile examples, directors and top executives are rarely replaced through a grassroots shareholders uprising. Instead, dissatisfied investors often choose to sell their shares. When the stock performs poorly, the board of directors might react by replacing the CEO. In some corporations, however, the senior executives are entrenched because boards of directors do not have the will to replace them. Often, the reluctance to fire happens because the board members are close friends of the CEO and lack objectivity. In corporations in which the CEO is entrenched and doing a poor job, the expectation of continued poor performance will decrease the stock price. But low stock prices create a profit opportunity. In a hostile takeover, an individual or organization, sometimes known as a corporate raider, can purchase a large fraction of the stock and acquire enough votes to replace the board of directors and the CEO. With a new superior management team, the stock is a much more attractive investment, which would likely result in a price rise and a profit for the corporate raider and the other shareholders. Although the words hostile and raider have negative connotations, corporate raiders themselves provide an important service to shareholders. The mere threat of being removed as a result of a hostile takeover is often enough to discipline bad managers and motivate boards of directors to make difficult decisions. Consequently, when a corporation's shares are publicly traded, a market for corporate control is created that encourages managers and boards of directors to act in the interest of their shareholders. Further potential for conflicts of interest and ethical considerations arise when some stakeholders in the corporation benefit and others lose from a decision. Shareholders and managers are two stakeholders in the corporation, but others include the regular employees and the communities in which the company operates, for example. Managers may decide to take the interest of other stakeholders into account in their decisions, such as keeping a loss-generating factory open because it is the main provider of jobs in a small town, paying above-market wages to factory workers in a developing country, or operating a plant at a higher environmental standard than local law mandates. In some cases, these actions that benefit other stakeholders also benefit the firm's shareholders by creating a more dedicated workforce, generating positive publicity with customers, and other indirect effects. In other instances, when these decisions benefit other stakeholders at shareholders' expense, they represent a form of corporate charity. Indeed, many, if not most, corporations explicitly donate on behalf of their shareholders to local and global charitable and political causes. For example, biotechnology firm Gilead Sciences donated $388 million in 2017 to charitable causes, making it the largest contributor in 2017. These actions are costly and reduce shareholder wealth. Thus, while some shareholders might support such policies because they feel that they reflect their own moral and ethical priorities, it is unlikely that all shareholders will feel this way, leading to potential conflicts of interest among shareholders. Now, what about society at large? Are decisions that increase the value of the firm's equity beneficial for society as a whole? Most often they are. While shareholders of Netflix have become much richer, its customers also are better off with the quality and availability of streaming content that they might otherwise never have had, which might be especially valuable during the crisis times such as COVID-19. But even if the corporation only makes its shareholders better off, as long as nobody else is made worse off by its decisions, increasing the value of equity is good for society. The problem occurs when increasing the value of equity comes at the expense of others. Consider a corporation that, in the course of its business, pollutes the environment and does not pay the cost to clean up the pollution. Alternatively, a corporation may not itself pollute, but use of its products may harm the environment. In such cases, decisions that increase shareholder wealth can be costly for society as a whole. In economics, we refer to such cases as negative externalities. When the actions of the corporation impose harm on others in the economy, appropriate public policy and regulation is required to assure that corporate interests and societal interests remain aligned. Sound public policy should allow firms to continue to pursue the maximization of shareholder value in a way that benefits society overall.
In this video, I would like to introduce you to an important tool frequently used in corporate finance to analyze corporate financial transactions. It's called market value balance sheet. Market value balance sheet is similar to a regular quote-unquote balance sheet that I put here for comparison on the right-hand side, with the difference that both assets and liability side of the market value balance sheet are quoted in market values, not book values. We traditionally distinguish two important parts of the liability side of the balance sheet, namely debt and equity, and we quote both of them in market values, which here denote as MV, and equity would also be quoted in market values, not book values. On the left-hand side of the balance sheet, we have assets, which again consist of cash and long-term assets, which would also be measured and quoted in their market values and not book values. For comparison, we can see that in the regular balance sheet on the right, debt, equity, and assets are quoted in their book values and not their market values. Different corporate financial transactions may have different impact on the market value balance sheet and on the regular balance sheet. And here we will consider several examples. Suppose a firm uses cash to build a factory. For example, Tesla uses its available cash to build a new production facility. What impact does this transaction have on both regular balance sheet and on the market value balance sheet? Let's start with the regular balance sheet. Let me schematically draw it. And here I'm going to separate the assets into cash and other assets, which I will call LTA, which stands for long-term asset. In this particular transaction, the firm uses part of its cash to build additional long-term asset. In this case, it's a factory. So therefore, it just turns one part of its assets into another one, and therefore this transaction has no impact on the right-hand side of this balance sheet. So in other words, neither the book value of debt nor the book value of equity are affected as a result of this transaction. Now, things are slightly more interesting for the market value balance sheet. Let me also schematically draw it and also separate assets into cash and into long-term assets. Let's assume for a moment that this transaction is a zero NPV transaction. So then in this case, the company again just uses cash to build a factory, and it doesn't create additional value on its balance sheet. However, if this transaction has positive net present value, then as a result of this transaction, the total value of long-term assets is going to increase more than the decrease in the cash that we use to build this factory. So therefore, we're creating this additional value as a result of this transaction, which again reflects the fact that the net present value of this transaction is positive. Now, in this case, the right-hand side of this balance sheet has to increase, and this increase has to be proportional with this NPV, so that the left-hand side of the balance sheet equals to the right-hand side of this balance sheet. Now, this additional value can accrue to either existing equity holders or existing debt holders. So this is debt, and this is equity. This depends on the extent to which the original debt was safe or risky. So something that we will talk more about in the second part of this course. If we, for a moment, assume that this positive NPV accrues only to the equity holders, then as a result of this transaction, the market value of equity is going to go up by the amount of this NPV. And so this new part would be the new value of equity. And we will see this in an increase in the share price. So when the firm announces that it has plans and it uses its existing cash to build a new factory, the stock price and the market value of equity is going to increase by the amount of this net present value that this transaction creates. Let's consider a second example. Suppose that a CEO of a firm dies in a plane crash. What impact does this tragic event have on the regular and on the market value balance sheets of this firm. Let's start with the regular balance sheet. Let me schematically draw it here again. So we have assets on the left, we have debt and equity on the right. Now, it is very clear that this transaction has no impact on either the book value of assets, because they stay intact, nor on the book value of debt or the equity of this firm. So, in other words, this event has no impact on the regular balance sheet at all. When it comes to the market value balance sheet, things are more interesting. Suppose for a moment that the old CEO was a great CEO and the new CEO is not as good. In this case then, the market value of assets will decline, and let's assume that it's declining by this much to reflect this value loss. This value loss is going to come from the fact that the plans that the original CEO had for the firm will not materialize, and this firm will not be as prosperous as it would have been if it was run by the original CEO. So the market value of assets of this firm is going to be this smaller part of this on this chart. Now, this value loss, of course, has to be reflected on the right as well, and so the right-hand side of the balance sheet is going to shrink by exactly this much, and this value loss can accrue to both equity holders and debt holders of this firm. Again, it depends on how risky the original debt was, something that we'll cover in the second part of this course. But it is almost universally the case that the value of equity of this firm is going to decline as a result of this event. And so therefore, we're going to see that the stock price reaction is going to be negative and the market value of equity of this firm is going to decline. Let's consider a third and final example. Suppose a firm issues debt to pay a dividend. What impact does this transaction have on the regular and on the market value balance sheets? First, let's start with the regular balance sheet. This transaction increases the book value of debt by this much. So suppose that this is how much we're taking on to pay the dividend. And it decreases the book value of equity by the corresponding amount, because this is how much dividend we pay to our existing equity holders. So therefore, this is the additional amount of new debt, and this is by how much the new debt grows, and this is by how much equity shrinks, and so this is the new value of equity of this firm. Notice that this transaction has no impact on the left-hand side of this balance sheet. So the book value of assets stays intact. Now, let's see how this transaction impacts the market value balance sheet. So first, the market value of debt will increase to reflect the market value of this new debt that we're issuing to pay a dividend. And this would be the new total market value of debt that this firm will have. The market value of equity will decline proportionally with the amount of dividend that we pay to our shareholders. And so therefore, together, these transactions or these impacts are similar to what we've seen happening on the regular balance sheet in book value terms. However, these may not be the only effects that are happening. Suppose that investors positively interpret this information, and as a result, the market value of equity increases by this much. This increase in the value of equity has to be reflected on the left-hand side of this market value balance sheet as well, and therefore the market value of assets has to increase by this much as well. So therefore, this transaction has this additional impact on the market value balance sheet. So altogether, the market value of debt increases, the market value of equity decreases, but not as much as it would have been if there was no this additional informational impact. And the left-hand side, or the market value of assets of this firm, increases as a result of this transaction. Overall, in finance, we're interested in understanding how various transactions affect the market value of debt, the market value of equity, and the market value of assets of the firm. Therefore, we primarily focus our attention on the market value balance sheet as opposed to the regular balance sheet, and therefore it has an important role as a tool in finance.